Back with closing trades right here on ET now, and while we're holding up quite okay, 26,200 in sight on the Nifty futures, IT, some of the defense, railway names are the ones which are the liquid buzzers in trade. It's good to see that the breadth of the market as well is holding out and not just the large caps, which had been the trend the past month or so. So 151 stocks standing to the advances right now, with a handful of 61 standing to the declines. Of course, there are days where one has seen better breadth, but it favors and is tilting in favor of the greens as we speak right now. Shriram, Wipro, Infosys, Trend, Bharti, they are significant movers from within the large caps, and Mazga Dock, 5.5% of an uptick there. RVNL, which is holding up a good 5% in trade. Solar Industry is up 5%. Nalco, of course, has been a very strong mover from the word go, 4.5% of an uptick. And then MCX, which is also holding higher in excess of 4% as we speak right now. But let's welcome on board Nimesh Chandan as well and find out what he's making of the market right now. Nimesh, hi, afternoon. Good to have you on ET now. Just wondering what the color and texture of the markets in 2026 is going to be like. More consolidation, you think, or do you think it's time that we will see a slight bit of a move up?
So we are quite bullish as we enter into 2026. If you just rewind a year back, and if you are sitting here in January 25, and we would discuss, okay, we forecasted that there'll be geopolitical issues, wars, India would end up paying the highest tariff to the US, rupee will depreciate to 91, 92, the FIIs will keep selling throughout the year. And yet, if you tell me that Nifty would touch a new high and 10-year bond yield will actually go down by 25 bips, I wouldn't have believed it. But through the year, we have seen certain positive developments which have given tailwind to the economy, to the profits, to the earnings growth in the second half of this fiscal. And I believe those will continue to push earnings growth and economic growth in the coming year. And these are steps taken by the government, revival in consumption demand, revival in capex. So these are all positives that we are seeing in economic cycle, in business cycle, in financial cycle that we are getting into 2026. So we at Bajaj Finserv Mutual Fund, we are quite positive.
Okay, and Nimesh, hi, good afternoon. I remember earlier in the year when we were interacting with you, you did mention that a mismatch or a lack of liquidity flows could affect the volatility in the market. But just zooming in on the last three sessions and the kind of FII buying that we've seen in the market, do you believe now FIIs have made a comeback for good? Are there props in the market? Are there levers in the market that could be leading to this FII buying to be sustainable?
So there are many reasons why India is positioned attractively. It's a fantastic diversification. It's an economy which is fastest growing. Earnings growth is reviving. So if you take from FY25 to 26 to 27, you're not only seeing earning growth, but the growth rate also increasing. So all these are positives. Actually, I would hesitate to draw a trend over a 3 day, three data points in the last 3 days. But these are definitely comforting that now there is less selling or more buying on positive days from foreign institutional investors. And looks likely that this will continue, although it can't be guaranteed as such. But India is definitely an attractive destination, especially after the time correction that we have undergone. See, India will not be trading at a discount to other emerging markets. There are certain characteristics of Indian corporates that make us trade at a premium to other emerging markets. But though that premium has come down significantly, and I think it's time for a catch up next year.
Okay, so that's your take on the market right now. Nimesh, the favor still remains tilted towards the large caps right now, or are you still seeing some scope of value and some valuation comfort in the mid cap and the small cap end of the basket now that we've seen a significant cool down from the highs?
So we've been positive on large caps since last 1 year, and we believe still there is scope for growth from there. Our intrinsic value, if that we calculate for Nifty, ideally currently in December, it should be about 26,700. So we are little lower than that, and this intrinsic value, as we roll over to the next year, will also go up. But recently, we've also become quite positive on the small cap space. There has been a sharp correction in small caps, And there has been a good divergence even within these 250 small cap companies. There has been a huge divergence of performances. There are many stocks which have corrected more than 20% in this year, and where business is good, management is good, and valuations have now, after a correction, become attractive. So while it is difficult to just generalize a average price to earning or a price to book for small cap, but there are many opportunities that we see where small caps are now at an attractive zone, and you can create a good portfolio of about 80 to 100 good small cap companies.
Interesting. So give us some color, Nimesh, on themes within small and mid caps that you're looking at.
Yeah, so interesting question. We look at mega trends. We believe that companies that benefit from certain changes in economy, in global businesses, and domestic businesses tend to have a tailwind for growth. And as their profits grow, the stock prices follow. So we track mega trends, and within that, we see some very important changes that are coming. So if you look at banking and financial services, we see a strong adoption of AI, also digital payments, participation in capital markets. So those themes will drive financial sector. Within healthcare, we very positive on CDMO companies, the custom drug development manufacturing companies. Here, these are the companies which are benefiting to some extent from the Biosecure Act that just got passed in the US. These companies have a strong order book, a strong track record of growth, and there is huge scalability ahead of them. So that's an area that we are quite positive on. We are taking some contrarian calls. So right now, we had taken some contrarian calls on metals, which has actually unfolded very well. We are positive in the entire consumption basket, but we find some epics in real estate very attractive, where they have done well, they've deleveraged their books, and the festive season sales have been, their numbers have been quite strong. So those we like. Consumption as a basket, if you see for the last 2 years, many small caps and mid caps in this category have underperformed. The investors have been too much focused on the capex side of the stories and less on the consumption side. From this quarter onwards, we'll see a pickup in consumption. So anything which are, say, related to real estate, home improvement companies, for example, paints, tiles, faucets, and wires and cables. So those we like. We like many food delivery companies where the valuations have corrected, the quick commerce companies. We like some in staples also, where we see higher growth rate, new product introductions also being there, and a lot in consumer discretionary side also. This is a space where you get quality growth as well as now at valuations.
So those are some of the pockets you're liking. But Nimesh, you did speak about the whole real estate and the real estate ancillary theme, anything close to home building. But one sector you didn't mention, I'm curious about this, is cement. Your outlook on cement next year, given that we've seen absolutely no price changes in cement internally, and the stocks also have not done all that much this year, do you believe because it's been such a lackluster year for cement, next year we could see momentum on either end for it?
Actually, yes, that's an interesting point, and I somehow missed that in my initial comments. After the price correction and the time correction that many of the cement companies have delivered, I mean, have seen in the last 1 year, we see some upside there also. However, when I look at in terms of risk reward ratio or the highest upside, I see many other sectors, but cement also will deliver positive returns in the next year, it looks like.
Okay, so that's on that. But Nimesh, your outlook on IT, given that very recently we've seen a good outperformance coming in from IT compared to the other sectors, but IT is also coming from a very dull phase. Do you believe that now is a good enough time to start allocating a little bit towards IT to just see where it goes from here?
I think last year the sentiment was extremely negative towards IT because most of the players or investors were focused on pure AI plays globally as well as domestically. So, which are the companies which are purely involved in AI data centers and so on. But now I think people are realizing that in terms of implementation, in terms of project flow, even these guys would, Indian companies would benefit. The valuations are attractive, and many of them are at very high dividend yields, like between 2.5 to 3.5, or sometimes 4% dividend yields. So attractively placed in terms of valuation, sentiment is now better. However, I will also put a caveat here that this is not a typical season where IT numbers start looking extremely good. So the December end numbers and March end numbers, because of lesser working days, may not be so great. But yes, the outlook from the sentiment side has improved for them, and they may see a rally to some extent.
Right. Okay. Nimesh, great to have you on the show today. Thanks for your time.
Pleasure being here. Thank you.
Okay. Well, since we are on the subject of IT, how can